I mean, RJ, there's a big crowd in here. I think it's time to get rolling. So welcome
Good.
everyone to this Placer AI webinar. And again, not just any. I think for me, RJ, I'm gonna say this for you too. This is our favorite webinar of the year. It
That
is
feels like we
retail
just did this, didn't it? It feels like we
Yeah,
just did
I
this.
know. So this is our trends webinar, and why we love this one so much is because we spend so much time trying to look at what's happening right now, and this is our chance to get crazy and start thinking about what's coming, and we get to really look at the data from an even more strategic perspective to ask what are things rolling and what are they impacting the next year. And this is conversations that we're already starting to have in the spring as we start to see really cool things of like, ooh, could this make the list? But for those of you who are interested, we do have a white paper around the same topic. You can email me. It's available on our website. Make sure we get that to you. But this is our chance to kind of talk through it. And I'm joined, as I always am for this specific one, but my good friend, my colleague, RJ Hadavi, head of analytical research at Placer. RJ, thank you for being here.
Yeah, absolutely.
And what we're going to do today is we're going to do, again, super brief introduction to Placer for those of you who are new and unfamiliar. We're going to go into our retail trends. That will be the bulk of the conversation. And then if we have time at the end, we're going to do a little bit of quick holiday reactions, though. If we don't have time, we'll make sure to focus on that in a coming webinar. And then as always, we're going to take questions. If you have a question at any point throughout the conversation today, please send that over with the Q&A function at the top or bottom of your screen, depending on how you have Zoom configured. Send those away. We'll try to get to them again within the course and flow of the conversation, so don't just wait until the end. Quick introduction to Placer. We'll breeze through this one even faster today. What is Placer? Placer is a location data company. What does that mean in the simplest terms? People vote with their feet. We're showing you how they vote every single day across the United States to retail locations. We do that by analyzing a panel of over 30 million devices very critically. This is all de-identified aggregate data. So we are GDPR and CCPA compliant. We then analyze that panel with machine learning and AI algorithms to make estimations on retail visits across the country. And we show that in a range of different reports within our platform on everything from cross-shopping, void analysis, visit counts, true trade areas, and a whole lot more. If anyone is interested, we have a free version of our premium product available at placer.ai. We also have an amazing section on our website called The Square that is the home to our free tools at placer.ai-the Square. But now it's time to dive in. And RJ, we're going to start with this. It's my favorite topic, and it's not even close. And I think we have done an entire webinar about this topic. Yeah. We'll definitely do more. But let's start with retail media networks. What is the trend? Why is it significant? And what does it mean strategically?
I mean, I think to understand what the trend is, you have to go back and trace back the last couple of years in retail. 2020 was the year of perseverance. Obviously, with COVID, people, stores didn't know what to do. They were just trying to get by. 2021 was the year of adjustment. Consumer behavior had changed. Our data shows it. People were doing things differently, different, behavior. And so you had to adjust. And then this past year really is the year of refinement and really optimizing your physical and digital assets for retailers. It's particularly important in a period of rising interest rates. You got to get better return on your stores. And so the idea, how do we do that? And we see changes in experience, we see changes in store formats, and we'll talk about some of this too. But I think the most significant one, and I agree with you too, retail media networks is a great way to get utilization out of your stores. A lot of people have seen what Amazon has been able to do with their advertising network, and it's not something. Obviously not every retailer can say, I want to do exactly what Amazon does, but there certainly are opportunities in this. And, we see in the data here that the in-store reach for a lot of these retailers is much greater than the online reach. And so why not, take that ability to partner with local brands and local stores, to really maximize that advertising reach and really make it a more profitable transaction and make your stores more profitable. It's something interesting. I was looking at the transcripts for a lot of the publicly traded retailers. Retail media networks came up 50 times in this last quarterly cycle. Even groups like PetSmart and Petco are talking about getting into retail media networks. Some of the players that you wouldn't expect to get in the space. A year ago, 5 mentions at most. So it's exploding on the scene. I think a lot of groups have started figuring out, but there's a lot of groups that are going to need help on this. But it's certainly not going away, especially this whole broader theme of maximizing the utilization of your stores. I think it's going to be prevalent. We're going to talk about it a lot today. I think that's the key theme as we look to 2023. How can I maximize the utilization of stores? And retail media networks is not a bad way to start.
It's a fantastic analysis. And it's the idea of the store, not just as a place to sell, but the store
Yeah.
as a platform. And it's something you'll hear kind of touched on in multiple places. Like it's coming. So a question came in, can you define retail media networks? So essentially retail media, and dive in here as well, RJ, retail media networks began as an online phenomenon where people were selling advertising space or advertising options within the customer journey on an online platform. So think on Amazon. If I looked up rice cooker, I'd have Ethan's rice cooker, I'd pay for ads and I'd be able to show that within that journey. And now it's coming in with kind of classic interpretations, everything from an end cap to digital signage, but it's expanding. So in-store sponsorships and pop-ups, but the idea is how close it is to the point of purchase, the ability to now measure the data, the recognition that there are opportunities to create those experiences that maybe just we weren't thinking of before, and just this fundamental shift in the way we view the store. So when we think about omni, it was physical retail, and then omni was everything around it. But now as we bounce back in the post-retail apocalypse world, we're recognizing that there's online lessons we can apply to the offline world in a more effective manner. And that's what's getting, a lot of folks excited and to think about things. One of the elements that really gets me kind of really excited about this is the new segmentation concepts. We think about demographic, psychographic breakdowns, and those are amazing and interesting. But behavioral, action-based segmentation is so fascinating. And it's a stupid example that I use far too often, but I think it's good. RJ, we do RJ and Ethan's protein bars, and we want to promote it through CVS. We want to figure out which CVSs to launch it in. We don't have to ask, hey, do you think it's 25 to 35-year-old men or women? Do you think it's this HHI? We can say which CVS locations have the highest cross-visitation with gyms. We want to get even more refined with Planet Fitness because we think that it's a more value-oriented protein bar and not as high scale. And so there's the first time movement within this space. It's still such a disparate network, so there's so much opportunity. I think there's a reason this is the number one for us, and I think it's because of what it offers in the short term, but also, as you said, what it means for just the evolution of how we think about brick and mortar.
Yeah, I think if you have to lock into a definition of retail media network, it's the ability for stores to generate impressions for brands. That's basically using their assets, whether it's physical assets, digital assets, to create impressions and put other brands out there and monetize it. So effectively, they become the advertising platform. Again, the store is a platform. That's effectively what they're doing here.
Yeah, I mean, it's a really, really interesting one. Next up, tenant diversity. RJ, same questions. What's the trend? Why is it significant?
Yeah, I mean, the trend here is that we see, particularly among Class A properties out there, this movement towards, different tenants, different mix. Traditionally, these have been largely retail tenants at these locations, but as we've seen with changes in consumer behavior through the pandemic, changes in migration, changes in even, wealth and wealth. Trends on that side, what you see is different tenants coming in, and so more co-working, more fitness, more entertainment, things like that, put into these properties, and as a result, the mix has shifted quite a bit, and even residential, office, things that are being included as well. So the mix of tenants is there. What a mall looked like in 2018, 2019 is very different from what it looks like today. The idea is that you get greater frequency. Honestly, our data shows that too. You get a better balance of your tenants. You don't have potentially tenants competing with another. I mean, I think we've talked about this before. Apparel is one of the categories that we've seen maybe fewer apparel stores, tenants at some of these A malls. And so you don't get this competition with that as well. So the idea is you're creating diversity. And again, going back to that theme we talked about first, really maximizing your store, your space right now, kind of getting the best utilization possible. And I think that's really what's driving this mix or the shift to more diverse tenants right now. You want to maximize the property you have. Maybe it's retail media networks, maybe it's diversifying your tenant mix. These are the things that a lot of property owners are fixated on right now.
Yeah, absolutely. I mean, I'm going to parrot our colleague, our head of real estate, Ben Witten, and pretend like this is my own idea. But what this idea, we think about malls as these, evenings, weekends, that's their core draw. These new tenants flip that on its head. They say, hey, we could have people come in the middle of the day, and maybe that gives a boost. And it's added strength to areas that weren't strengths before, and it creates an overall better experience. I think it's a really exciting trend for these malls.
It's a
Yeah,
halo effect. I mean, what you see is
100%.
more people there at more times. It creates, opportunities for not only more frequent visits, but upsell. You typically see higher tickets at some of these more diverse places. The retailers that are located at these more diverse centers typically see higher tickets, more loyal customers. I mean, there's a real halo effect with this movement.
That's a fantastic point. I want to get to a question that came in, and granted, we're taking a step back here before we jump forward. But we had someone ask, how do retail media networks affect retail staffing? I mean, I don't know that there's such a direct effect. I think it's about, it depends on what the type of kind of media or advertising campaign you want to run. I think it's more about maximizing reach and leveraging a new channel to reach audiences where there's high intent, where you're close to the point of purchase. I don't know if you feel differently, RJ.
Yeah, I mean, at the store level, kind of at the operational level, I mean, there's almost minimal changes there. I mean, the retail media network is going to be run more at the corporate level. Most, particularly the large retailers at this point, have their in-house retail media networks, or they're outsourcing to another group. So I would say in terms of the operations of the store, there isn't any additional staffing required. Maybe a little bit of training that goes in place just to make sure that the employees know why it's there and what's happening. But at the end of the day, I mean, there's very little at the store level, at the store operational level. There really shouldn't be any changes on that front.
Yeah, another question also came in saying, talking about Kroger. They've said they've been increasing online delivery as retail media networks and floor realignment in their strategy. I think, look, I'm not a Kroger expert, but I think Albertsons was one of the leaders in this space. I think Kroger's always been one of the leaders in kind of grocers that really take advantage of data and analytics, and I think they're seeing the same thing. I would be shocked if this isn't a big part of their strategy. I don't know if you feel differently.
It was the number 2 bullet point in the press release announcing the mergers. So I mean, I think that's pretty square where their intentions are here.
Yeah, absolutely. I mean, so yeah, that's a better way of answering it than I did. But yes. All right. Next up, small format shifts and shop in shops. We jammed these together, and we probably shouldn't have because they're both super interesting on their own. But RJ, what's the trend? Why is it significant?
Again, I think it goes back to this idea. You've got to maximize the utilization of your retail assets, your retail stores. Maybe what you see is that your stores are too big. And it's actually interesting when we look at, CVS, which announced, last year, they announced they're going to close 900 stores. And we started looking at some of the stores that were closed. And what was surprising is that some of these stores were in the 90th percentile in terms of overall visitation trends. So they're one of the more popular. But then when you go and look at visitations on a per square foot basis, again, something you can do in the place or platform, then all of a sudden they drop from the 90th percentile to the 30th percentile. So again, showing that you're not getting maximum utilization out of those locations. So we're seeing a lot of places shrink the size of the store, and in a lot of cases that makes sense. I would say it's not universal though too. So just by shrinking your store doesn't automatically mean that smaller format's going to work. It's really something you got to make the experience so worth it. You got to do the other adjacent things, the omni-channel experience there as well. So that's the first part in terms of smaller stores, why we see it is groups trying to maximize the assets. Now, shop and shop is a really interesting one to me too, because what we're seeing, I think what we see is that, hey, we're going to put in whatever it may be, Claire's Macy's, Toys R Us Macy's, Petco Lowe's. We're going to bring in a smaller retailer. We're going to allocate some square footage to them. What we're going to do is, be able to better target some new customer groups with it, fill in a gap with our product mix. But what the really interesting thing, again, throwing back to this idea of, improving the utilization of your location, typically what's going to happen is they're charging that smaller retailer rent on that square footage as well. So it ends up being a higher margin transaction or a higher margin business for these companies as well. I think a lot of times I think about the store and store from the perspective of the consumer. You got to think about it from the larger retailer. Again, we're trying to maximize what we do as a business operator. In a lot of ways, it's kind of reminds me of Amazon when they moved away from being the direct retailer, the first party retailer, and it started expanding their marketplace to be a third party marketplace as well. So this is kind of what I see kind of taking place within the physical stores too. So a lot of trends within those 2 trends that you mentioned, but it kind of goes back to this idea that this year really is where retailers are maximizing their square footage.
Yeah, I mean, that idea of kind of this push to efficiency is so significant, especially with small format. And I think the other piece of it is how do I go to the place I want to be? And, it certainly demands, it creates some challenges in the sense that, I need to figure out my merchandising. If I don't have as much space, I have to optimize what I'm selling within each location. But there are retailers who get that to a really high degree. I mean, Target's a great example of that. But it's a super significant opportunity, and I think the shop and shops as well in terms of what it gives you in new reach and the ability to kind of create excitement and some urgency, and also what it means for brands that there's another channel to get into retail. So a couple of questions have come in. One asked about Sephora, Kohl's versus Ulta, Target. I think the answer, the interesting thing about those ones has been, first of all, they both clearly had brought some power to those two chains. So Ulta's made a difference for Target, Sephora's made a difference for Kohl's. I think Ulta, Target was almost like two awesome brands who kind of speak to the same audience coming together. Are we shocked that it's worked? No. Sephora, Kohl's, there were more question marks. Does Sephora belong in these markets? Does it belong with Kohl's? I think the success there, where you look at Kohl's locations still performing better, those with a Sephora in them, outperforming those without, that's a pretty significant, wow, well done to Sephora and what their draw is in areas that they were not traditionally associated with.
Yeah, I mean, it's been fascinating to watch that from the first iteration of stores, those first 4 stores that opened up in August of 2021 to, effectively going to all stores, having some sort of Sephora presence at all stores at this point. Sephora's parent company talks about how successful it's been. Our data shows that, generally speaking, the visitation trends for those stores that had the early Sephora locations had outperformed this idea of mid-single digit lift in visitation. But more importantly, it is certainly diversifying the customer base. You're seeing younger audience come in, which is a lower household income audience, but that's okay because that can translate into a longer lifetime value for these locations as well. It's a more ethnically diverse group that's coming in as well. And what you see is this trade area size of these locations. And particularly in the Midwest, it can expand by as much as 20-25%. So you're pulling in a reach from a much wider audience. So I think that it's accomplishing what it is. With these store-in-store shops, though, too, you got to be careful not to get too spread out there, too, and too dependent on these brands, too. It's also, you got to keep in mind that you got to make sure Kohl's, that you give people a reason that they're coming back to Kohl's, too. So I think that's kind of the learnings that the company is going through right now. Is we're doing really well attracting this audience. Now, what else can we do to keep them in Kohl's and keep these transactions going, frequency, visitation, loyalty, things like that?
Yeah, I mean, a great question just came in. A bunch of great questions came in. We're trying to get to as many of them as we can, I promise. Please keep on sending. One just came in about Disney and Target. Is this causality? Like, were the Disney shops placed in higher traffic areas, or did the increase following the Disney shops come after being installed? I think the answer is that I don't think it's a lot of new visitors. They clearly drive a boost, but it's there is a frequency boost, and it's when you compare ones in close areas of close proximity, like two Targets, the ones with the Disney are certainly getting more pull from like families. So I think it's speaking to a certain demographic. I think it's driving larger basket sizes. I don't, let's be clear, the bar with Target was so high. I don't think it's like people are now figuring out that Target's a great retailer because of Disney. But I think they're probably larger basket sizes. And I think those with families are orienting themselves around those stores because I just did it because that's what my children want in for their holiday gifts. And so I think it's more that as opposed to causing some massive boost in visits.
Yeah, I think it's just, exactly. I think it's just matching. Disney knows where their core demographic is, and it generally lines up pretty well Target. And so it's just a natural partnership. Disney products sell very well at Target. Why not just expand it and make it a store within store partnership?
It's a great store within store. Like, it's a really, I mean, having just done it, it's super effective. They play the music in the area, gets you in the Disney mood. It's fantastic. The mall waterfall. For one slide, everyone, I'm going to kick off because this is the one that we've gotten the most flack for, but it's one I believe in very strongly. Well, RJ, you can ask your question. So what is the mall waterfall? We talked about this before. Top tier malls are getting more focused on a more diverse array of tenants. At the same time, those top tier malls are more in demand than ever. At the same time, there is a long tail of retailers entering into physical retail, digitally native brands, direct-to-consumer options like Puma, Nike, etc. So there is more demand for fewer spaces. So what are the retailers that are looking for these spaces going to do? Some of them are going to go to high streets. Some of them are going to go to downtown areas. Some of them are going to try out strip centers. But some of them are going to still look at mall options. And so our feeling is that there is an opportunity for smart, well-run B-class malls, and in some cases beyond, to think about how do I orient myself around those retailers to grab some market share by being complementary to the major regional center. Don't try to compete and be as good as that, massive top tier mall right nearby. But can I build around some of those who can't find a home in that mall anymore? Can I create a tenant mix that's exciting or speaks to a specific audience? I think the answer is yes. And I think you're going to see a group, if not a large group, of B-class malls up their game as a result of the growing opportunity available to them. RJ, your thoughts?
I think that's exactly on. I mean, that's exactly what it is. As these Class A malls become more diversified, bringing out non-traditional tenants, that's pushing out some of the traditional tenants, particularly in some categories like apparel, and they need a place to go. It's not like we're not trying to target same people in that market. So the option then becomes some of these Class B malls, and I think a lot of smart operators are starting to realize this could be actually a very high return opportunity. Just maybe renovating a Class B mall, opening it up to some of these tenants that maybe got left aside through this diversification process. Open up to digitally native brands, because what we're seeing here is retail store is a much better use for customer acquisition costs right now. Much more effective way to acquire customers than online, particularly some of these changes in Apple IDFA and other things that made it more costly to bring in customers. So they need a place as well. These Class B malls, at least that for a lot of these concepts that maybe not be as certain, maybe some questions about, they become a viable option. And I think to your point, the challenge is creating an exciting mix of tenants, but it can be done. We're starting to see some success stories where people taking maybe or an operator's taking control of a mall that maybe it's just lost its way, and start to remodel some of the storefronts, things like that, and bring in new tenants. And I think it's going to be a trend to keep an eye on this year. It could be a big movement.
Absolutely. One question that's come in, and it's coming about specifically the data we showed on the retail media slides, and I'll try to go back so we can see that for this one. It was about if Target is doing so well, why is there just minimal improvements? I think the answer here is kind of this is a great metric to look at the comp between offline and online visits. It's not a good metric to measure retail performance. We prefer year over year, year over 3 year, because it doesn't take into account seasonality. So it's not that 100 people visited your store, then only 102 or even only 90 visited your store the next month. What matters is the comparison to the relevant period beforehand. So when we look at Target, when you look at year over year, year over 3 year numbers, they're consistently one of the strongest performers when you look at what they're doing offline. And from what we understand, it's been very similar online as well, where the traffic is there, and especially relative to the rest of the market, they're among one of the strongest performers.
I mean, if you break out retail and consumer staples right now, overall, we're looking at about negative low single digits in terms of year over year visits, roughly the same compared to 2019. But discretionary retail, especially with inflation becoming such a big issue, we're running between -5% and 10%, depending on the category. In some cases, even higher than that. So looking at Target and looking at their year over year numbers being slightly down, that's not a bad thing. I mean, actually, they're outperforming the rest of the category, and even suggest visitation market share. So,
yeah, I mean, I agree with you completely. And one of the things we've looked at a lot is visit duration. A question came in about how do you look at things like basket size. So visit duration is usually a good indicator of people spending more time in store, purchasing more items as their visits have dropped. And again, they're not huge drops by any stretch year over year. When we think about October, especially, that was one of the strongest months October's Target's ever had. It was slightly down, and visit duration was up, meaning there's likely an accounting for it in those two, in that combination of perspectives. But now on to dining, and this is obviously, RJ, a sector that you know extremely well.
Yeah.
What is the trend when we think about, because I think we often say, oh, it's an incredible situation. The stars are aligning for QSR, for FSR, but you think that there might be some obstacles ahead. What is the trend? Why do you think it's significant?
Yeah, it's been interesting to watch the overall dining sector because it's been, you have to break it out by subcategory. I don't think it's enough just to say, oh yeah, overall dining visitations down. There's a lot of nuance to it. So if we go back to March this year, that was the trigger point for a lot of consumers, particularly that first week in March when we saw the big spike in gas prices. Consumers at that point, they've been feeling pain both at the grocery store, at restaurants. Inflation was running roughly in the 7% inflation at that point. And so, it had already been taking a toll. But then when gas hit, I think it really, triggered something in a lot of consumers' minds that I'm paying a lot more than I used to. And so what we started to see immediately almost was to trade down, or not even trade down. We saw QSR and the more value-oriented players really outperform. We saw a lot of people take a pause on dining out. A lot of times that lower income consumer that was going to casual dining or full service restaurants traded out. So we saw QSR outperform really throughout much of the summer. Visitation trends. But then as we started to look late in the summer, this is the point where restaurant companies, they're facing a lot of inflation too. Food has gotten more costly. Labor in particular still remains a big headwind for restaurant operators. So what we started to see is this 8, 9, even in some cases like a Chipotle, 12, 13% menu price increases. And as we got to late summer, that became a barrier for a lot of consumers. They just didn't have the household budget for it. Chipotle talked a lot about their high-end consumers continue to come in, but that lower-income consumer really opted out. And so I think we're starting to look at a situation where QSR and fast casual chains may have priced out their customers in a lot of cases. And, that's really about driving, this emphasis of value or bringing innovation right now is what's driving traffic. If we look at somebody like McDonald's, which we've talked about it many times, they've done some really effective celebrity promotions. They've done some great things in terms of, this adult Happy Meal promotion, which actually raised the entire QSR category by visitation trends by almost 6 points in the month of October. So they've done some really innovative things. And so it's not just enough to say, really consumers are fixated on value, but they also will come in for innovation right now. So those are the stores that are doing well. Full service restaurants are still down, but they're kind of on par with QSR. And I think that's just the case where the higher end consumers continue to go in for the full service dining. There's a tremendous amount of demand. And ultimately, we're in a situation where inflation has really gotten to a lot of consumers across that lower income bracket, that middle income bracket. And so restaurants got to pivot and adjust to that change in behavior right now.
Really, really kind of important in terms of how these sectors are recovering. But I also think that there's obviously inflation has a significant impact, but I do think it's important that kind of that breakdown of it has an impact in certain areas, it has a much larger impact. So within certain segments, if you were a value oriented before, you're probably still in that value oriented lane. Maybe you're looking to maximize trips, but there is the group that is kind of trading down, the group that is deciding not to go. It's important to understand who that is, and then how do you kind of better utilize your other parts of the kind of your market and better kind of market to them and speak that language in the right way. I think luxury is a category we've talked about a ton. Visits have gone down, yet their revenue's gone up because they know how to speak to their audience very effectively. Another one that we talked about quite a bit, but I think it's super interesting, is stabilizing migration patterns. So, if before we saw this dramatic shift in, even if it was just accelerated patterns that we were already seeing, that still really significant, we've seen that start to stabilize. What's the trend? Why is it significant?
Yeah, I think the trend here is we have seen migration away from a lot of urban markets like San Francisco, Chicago, New York, Los Angeles, and to certain markets like Dallas, Tampa, Phoenix. So that's one of the big trends we've seen, but I think it is starting to stabilize. A lot of people initially thought that when we saw this migration, when things return to work started to happen, we start to see this migration back to urban cities. And I don't think that's necessarily happening. I think a lot of it is the variable here is return to work and a lot more, hybrid models, a lot more flexibility and where people can work. I think some of these migration trends are here to stay. And so as a result, what's happened is a lot of the trade zones that a retail location was built in may have changed significantly. And so I think retailers got to be mindful of that the trade groups that you're going after, the demographics you're going after may have shifted quite a bit, either through migration from one city to the other, or even an urban migration to the suburbs or rural locations. And you and I've talked about the idea that smaller markets are becoming more attractive to a lot of retailers. The idea that maybe a market that had sub 100,000 people didn't have the economics before, but all of a sudden that market that was 70,000 is now 120,000, maybe in Montana or Idaho or something like that. All of a sudden, these retailers can actually get in and make see higher visitations per location. They get access to the first to the labor first in that market, less competition. We're seeing it across a lot of different categories, whether it be restaurants, Chipotle's talked about it, Petco's doing very well in small markets, Planet Fitness is seeing some success there as well. So I think this idea of migration, it's stabilizing, but it's changed the trade areas. It's made some small markets more viable, all things that retailers need to be looking at when they're planning out real estate growth strategies here in the future.
Yeah. It's such a great point. One of the things, places I first saw this was when you did some analysis on Starbucks, and Starbucks is moving to some smaller smaller areas, and you were looking at visit share in those areas, and it made it seem like there was a massive opportunity in those places. I think that also the important thing here is that visitation is starting to stabilize in other areas. So like New York is down less than it was. San Francisco is down less than it was. So they're starting to come back. It does feel like there is a stabilization trend where you're seeing those major urban areas start to come back. There is a slight dip, in terms of the pattern for some areas, but clearly there's been a shift. And another analysis that you had done, you looked at retailers that had the biggest change, and one of the things you had found was that Costco's audience had gotten the youngest in terms of where they were pre-pandemic. And if you're aware of that as a retailer, if you're aware of how those shifts are affecting retailers as a landlord, you kind of can identify different types of opportunities and upside. And I think it's really, really exciting. Yeah. Office balance. This is one that, this was a very popular topic when we were in ICSC last week. What's the trend? Why is it significant? And I'd frame this even a little bit better. Basically, what we're trying to grapple with is what we're seeing now. Is this what office looks like moving forward, or is the new normal a ways off still?
Yeah, I mean, it's a great question, and I think we're all still trying to figure it out. To be honest, this, to your point, was the number one question I think I got from property owners, retailers, and other investors looking at this general category. It was what is going on with the return to work, because a lot of people thought we'd be a lot more return to work at this point too. But frankly, we're still kind of in this 40-50% people below where we were prior to the pandemic in terms of office visits. Some of that's just people permanently working from home. Some of that is people doing this hybrid model where they're only coming in 2-3 days a week. And to be honest, I don't think we've hit the point where we really know what's going to happen in the space. I think if we're looking at least 2023, I think right now it's looking pretty similar to what we have. I think what we will see, what I'm hearing from some groups, is that we're kind of seeing this peak in the middle of the week. The hybrid model skews more towards Tuesday through Thursday. And so employers are trying to figure out a way to spread that out, maybe bring people on a Monday, maybe bring people on a Friday. Good luck with that. I don't know if that's going to happen, but that's kind of the thing we're seeing, is spreading it out. But I think this hybrid model has shifted away from just being something that it was a way that needed to happen during the pandemic to an actual perk for a lot of employees that a lot of groups are trying to figure out. And I know there's been a lot of discussion what happens that unused office space. We're going to see offices start to shrink, become smaller. That's going to open up a lot of potential real estate. And harkening back to some of the things that Ben Witness said here too, I think there is a real opportunity to convert that into other uses, whether it be residential or something else. So I think that's going to be the next step, is kind of see where that shakes out, and then from there we'll figure out what ultimately that return to work pattern looks like. But I think a lot of these offices are trying to figure out, all right, what works for us, what works for our employees, and then we'll make next steps in terms of what the square footage we need, and then make decisions from there.
Yeah, I mean, I think it's a great point. One of the things that we were talking about this yesterday on another conversation, but it's the challenges of doing those reconversions. And he was bringing up points of even the plumbing is so different. The way you kind of lay out, it's a costly process. It's going to be interesting. Do we see examples of how to do it? And again, how much of a shift will there be? I think there's a natural kind of likelihood of shrinking that footprint, but I still think office spaces are necessary. I'm kind of the opinion that companies are coming to terms with the fact that the office might be, if you come in less, then the space might even be more important. So maybe you need slightly less of it, but you need to invest more in it, make sure it's in a great place. The placemaking within office buildings becomes an important element of how do you make your building a draw. I think I think what's fascinating to me about this conversation is I have no idea. It's one of those areas where I'm just constantly asking other people with expertise what they think, because it just doesn't, for whatever reason, this one, it's really hard for me to come up with
it's one that touches all the verticals that all the groups we work with at Place, right? I mean, it's not just the companies and the office buildings themselves, and you're certainly right that they have to incentivize people and do things right, but it's also the retailers in the surrounding area. Those corporations have to bring in the right retailers. It's the municipalities, it's the cities that have to incentivize people to come in, and I think this will come in. I think where we're at, we'll continue to trend in back to return to work, but I think it's also going to take time. We're kind of at a stasis point here. We're kind of a stopping point where people, those changes need to make happen before we start to see a more pronounced return to work at this point.
Yeah, I mean, it's a fantastic point. All right, the Q1 retail bump, what's the trend? Why is it significant?
Yeah, so if we go back, I mean, and again, that, just 12 months ago, which again seems like just days ago, if you're anything like me, it just seems like it's just been a blur this year. Q1 was a period where we saw a lot of down traffic just because of Omicron, and we were still dealing with the variants there as well. So if you go back January, a lot of things were still getting canceled. A lot of stores still had restrictions on when they could come in. And so all of a sudden that leads to a situation where first quarter of 23, we might actually see some real positive growth here too. And there's a lot of other variables that could play out too. I mean, you think about the news that was going on last year ahead of the holidays, a lot of supply chain issues. Retailers were urging you get in early, or you might not get, certain inventory. So I think if you look, we're actually looking at a situation where first quarter visitation trends might end up being better than a lot of people think, just because we're lapping such easy comparisons. Now, the caveat to this too is that we're still dealing with an inflationary environment that's still weighing on consumers' ability to spend, and there is trade down and trade out. We're also really haven't seen the impact of rising interest rates. That's going to start kicking in for some car owners, homeowners, things like that. There's some variables on the interest rate front too that's still yet to hit. But generally speaking, if you're looking, we had pretty the first quarter last year with some down visitation trends. So that leads us to believe first quarter this year might be a lot better, perhaps better than what people are expecting here.
Yeah, I mean, I agree with you. And I also think there's an opportunity when, there's still obviously online's a big piece of the holiday shopping puzzle. Gifts are a big piece of the shopping puzzle. And then therefore returns are a big piece of the puzzle. And so that, having that period taken away for retailers, even if people were able to do returns online, it's still more costly. I think bringing them back in the store, that chance for upsell, that early kind of January boost is something we see very consistently in some years. I think it could be really powerful. A question came in that, I kind of smirked at and just wrote back, no comment. But hey, this is our webinar. We can do whatever we want. And it was an interesting one. He said, Elon Musk, the now kind of leader of Twitter, said basically, show up or ship out. Is he a prophet or is he missing the point in office? I mean, I'll kind of start. Like, I think I would less use that example, and I'd more use Stephen Ross saying it several months ago. The environment was very much an employee's environment 4 or 5 months ago, where you could kind of choose your job. It was a great opportunity. I'm going to live wherever I want. What are you going to do about it? I think that's balancing out. I also think a lot of people are realizing there's value to the office. There's value to being together. It's going to be important to see how those things play out over time. Do I think we're ever going back to everyone's working 5 days a week as a standard? No. Do I think 3-4 days a week is going to be there, and that I don't know how much of an end in the end impact it's going to have. I think other things that are having an impact are kind of wider economic challenges on companies looking to cut costs. So the question is it virtual work, or is it the fact that, the stock market's getting hit and therefore I'm concerned about my, my margins, and so I'm spending a little bit less on office? I think there's multiple things happening at once. I think that gives me a more optimistic viewpoint about office. I don't know what you think.
Yeah, I think I agree with that too. I think what's interesting to me is if you look at the migration patterns, again, this movement to suburban and rural, we've effectively decentralized a lot of the markets that are out there. But to your point, I mean, we see a lot of employees still see the need to congregate with other employees, to collaborate on projects, things like that. What I end up seeing is because of that consolidation, a lot of office spaces are going to, effectively follow suit. They're going to shrink the size of the overall office. And, again, it's similar to what we're seeing in overall retail as well, but maybe open up new offices too. And I think they're still trying to figure out where those markets are and the best market for that. But, I was talking to a commercial real estate executive last week, and like, I've been on the road all year, but I just pop into different offices across the country. And that's actually become a very effective way for me to work. I, stay in front of my teammates a lot more. And so that could be something like the norm too, where it's just like, maybe it's a smaller offices, but in more locations, kind of decentralized and spread out, than what you maybe thought of there too. I think that could still work, and that, dovetails nicely with some of the virtual work as well.
No, that's a great point. Last one, patience. You know what? I lied, RJ. I'm going to take 2 of them. I'm going to take this one too.
Yeah, go for it.
The reason I want you to show some patience. No, the reason is, so what's the trend? The trend is overreaction is a challenge. And for anyone who's out in the retail environment, you remember 2 to 3 years ago, the dominant narrative in our space was the retail apocalypse. And that retail apocalypse narrative was fundamentally false, but it was based on certain elements of truth. Like, there were retailers that were closing stores, online and e-commerce were on the rise, but the conclusion that there's an apocalypse happening was fundamentally flawed. And I think we've seen similar exaggerated conclusions. As an example, we love the fitness one because in the middle of June 2020-ish, there was this conversation of goodbye gyms, hello Peloton. We're never going to go to a gym again. I don't want to be around sweaty people when I work out. And then here we are a few years later, and we're in a slightly different position, right? We recognize that gyms made a tremendous comeback. We think Peloton, the demand was pulled forward to a significant degree. And what it's essentially asked us to do is be a little bit more cautious with kind of overly aggressive or exaggerated predictions or speculation. And I think there's some other cases where this applies. So one of the ones that really pops out to me is, brands like Old Navy, where a few years ago we were saying they need to spin off from Gap. They're so strong and they're being held back by these other brands. Now they're struggling a little bit. Does that mean they're going to struggle forever? Or does that mean they're in an environment that's uniquely challenging? And so I think almost grading on a curve, having that ability to kind of ensure we keep context in mind is so important to understanding who's really succeeding, whose long-term trajectory has really been affected.
Yeah, I mean, the takeaway on this one for me is, and one of the key themes for 2023, which categories were beneficiaries of pull forward versus which categories have actually seen structural change. There's certainly cases where it's been pulled forward. I think home furnishing, consumer electronics, certainly cases where it's pulled forward. We see that in the visitation trends. But I think other categories where fitness in particular, there's structural changes taking place here too. One of the things I looked at, because I've been getting the question a lot from property owners, is historically speaking, in a cyclical downturn, one of the first things consumers take a pause on is gym memberships. And are we going to see that same trend pull out? I'm not going to say if we're going into a full-on recession, how long it's going to be, but certainly I think we can acknowledge as a cyclical downturn. And you look back the last big downturn and some of the publicly traded companies and what happened to membership bases that, they got hit pretty hard. But I think it's going to be different this time around. And, I think what we see is, Planet Fitness is a big part of this too. This lower $10 price point, and so many other competitors have, copied that and gone to that as well. I think that's a little bit easier for most consumers to afford, but we've also seen the shift to a younger demographic, the 15 to 25, the Gen Z and millennial. We've seen a lot more migration to these lower price clubs. That I think will insulate a lot more too. And people just generally working out more. Planet Fitness had an interesting stat at the time of their IPO in 2016. Most people were coming in, 5 times a month. That number is now 6 and sometimes 7 times a month. So I think that, this gives it a little bit more resiliency in the category. And ultimately, things have structurally changed in this category. So I think that's going to be a big part for anybody who's looking at the space as an investor, an owner, a tenant. What has been a pull forward versus what has structurally changed. And it's not easy, but there are ways to look at it.
I very much agree. As expected, we did not get into our holiday analysis, but good. Now we have another thing to discuss.
Yeah.
For those who are interested, I'm plugging into the chat right now the link to go to get the recording. Very often people go back to the Zoom and it doesn't work because it's been moved. It's a YouTube link now, or will be tomorrow morning Eastern Standard Time. I want to thank everyone for joining us today. RJ, thank you so much for being here. This is the longest break we'll have between webinars. Our next one will be, I believe it's January 12th. We're going to have a retail analyst from Salesforce joining us. We're going to talk a lot about online, offline, and the interactions and what we saw during the holiday season. Please join us for that one. We also have a bunch of things that we'll be sending out in the near future. We did a in-person event in New York just a week ago, the day before ICSC. We had some really brilliant speakers on those panels. We had Brandon Eisner from CBRE, our good friend David Spahn from Brick-and-mortar. We had guests from JLL and from, excuse me for forgetting, URW and many others. And it was really just an amazing series of conversations. We're going to send those out. Please take a listen. We'd love to hear your feedback. But most importantly, thank you all for joining us today. Thank you all for those of you who've been joining us consistently throughout the year. We really appreciate it. This is so much fun for us and we really enjoy it. Feel free to email either of us, Ethan@placer.ai, RJ.Hodavi@placer.ai. We'd love to hear the things you want to talk about, what you want us to talk about next year, the things you want us to improve on. We always want to make this better. And even most importantly above that, have a wonderful holiday season, a wonderful time hopefully with family and friends. And happy holidays. RJ, happy holidays to you.
Likewise,
happy holidays to everyone who listened. And have a great rest of your day.